What if I told you the first half of 2026 could be one of the most important periods for your portfolio in the last 10 years? Wall Street is buzzing, and it's not just noise. We're talking about a potent mix of Federal Reserve action, supercharged corporate earnings, and the unstoppable force of artificial intelligence. This isn't just another market forecast. This is a deep dive into the forces shaping the next major wave of wealth creation. So, get ready, because over the next 10 minutes, we're going to break down exactly what to expect from the U.S. stock market from January to June of 2026, month by month, sector by sector. First, let's set the stage. What's the big picture? 3 major forces are at play. Number 1, and this is the big one, the Federal Reserve. All eyes are on the Fed because markets are betting on interest rate cuts in 2026. Why does this matter so much? Lower rates are like rocket fuel for stocks. It becomes cheaper for companies to borrow and expand, and it makes growth stocks, especially in tech, look way more attractive. Even the expectation asterisk of a rate cut can send markets soaring before it even happens. Number 2 is moderate global economic growth. Now, moderate might not sound exciting, but it's actually the sweet spot for U.S. stocks. When the rest of the world is just chugging along without any major drama, global investors tend to move their money into the safest and strongest market on the planet, and that's the USA. This influx of capital provides a powerful tailwind for the S&P 500. And number 3, the engine of it all, corporate earnings. Analysts are projecting that profits for America as biggest companies are set to accelerate in 2026. Think about it, stronger profits are the fundamental reasons stock prices go up. When you combine that with the promise of lower interest rates, you get a recipe for a very strong market. It's like hitting the accelerator while the road ahead is being paved. So, how will this all play out month by month? Let's walk through the timeline for the first half of 2026. January and February are likely to start strong but bumpy. The market will kick off the year with all that rate cut optimism already baked in. Expect technology stocks to lead the charge right out of the gate. We're talking about the big names in AI, semiconductors, cloud computing, and automation. However, don't get too comfortable. Any surprise inflation report or a jobs number that's hotter than expected could trigger quick, sharp pullbacks. Volatility will be the name of the game as traders try to read the Fed tea leaves. Then comes March, which I'm calling the big turning point. Why? 2 reasons. First, companies will release their final earnings reports from 2025. But more importantly, they will issue their official guidance for 2026. This is huge. This is when CEOs tell the world how much money they expect to make. If the tech titans come out and forecast booming revenues driven by widespread AI adoption, the Nasdaq could absolutely surge. But if that guidance is weak or uncertain, we could be looking at a multi-week correction. March is where the market's optimism gets its first major reality check. From April to June, the momentum should really start to build. This is when the talk about the first interest rate cut will get very loud. The market often rallies hard on anticipation alone, well before the Fed actually makes its move. As the economy shows signs of strength, we'll see a leadership rotation. Money will start flowing into what we call cyclical sectors. These are industries that do well when the economy is booming, like financials, industrials, and consumer discretionary stocks. Think banks, construction companies, and retailers. Your defensive stocks, like healthcare and utilities, will probably lag behind unless something spooks the market. Now, no forecast is complete without considering different scenarios. Let's talk about the base case, the bullish case, and the bearish case. The bazi-kazi, which is the most likely outcome, is a steady uptrend for the market. We see moderate gains fueled by that solid earnings growth and the expectation of Fed rate cuts. There will be pullbacks along the way, but they'll likely be short and seen as buying opportunities. So what could make things even better? That's the bullish case. Imagine if inflation falls off a cliff faster than anyone expects. Imagine the Fed is forced to cut rates earlier and more aggressively. And imagine if AI-powered revenues just explode, blowing past all projections. In that scenario, the S&P 500 could shatter even the most optimistic price targets. This is the dream scenario for investors. But we have to be realistic and consider the risks. What's the bearish case? This would be triggered by inflation that just won't go away, forcing the Fed to delay its rate cuts. Or what if those corporate earnings we're counting on come in weak? Add in a major geopolitical shock, and you have the ingredients for a much longer and deeper correction. This is the scenario that keeps investors up at night, and it's why risk management is so crucial. So, where should you focus your attention? Let us talk about the sector leaders for the first half of 2026. It is no surprise that technology will continue to be the star of the show. AI, semiconductors, cloud computing, and cybersecurity are at the heart of this revolution. They benefit hugely from lower interest rates and have massive potential for profit growth. But don't sleep on the other sectors. Industrials and consumer discretionary stocks are set to rise as the economy picks up steam. Think about it. Lower rates mean more people are financing cars, renovating homes, and buying goods. That directly benefits these sectors. Financials are another key area. Banks and lenders profit from increased loan demand and a healthier economy. And finally, you have your classic defensive plays, healthcare and utilities. They might not give you explosive growth, but they act as a great safety net or hedge if the market gets choppy. To stay ahead, you need to know what catalysts to watch. Pay close attention to every word from the Federal Reserve. Their meeting minutes and speeches will move markets. Keep a sharp eye on the monthly inflation reports, CPI and PCE, and the jobs numbers. Of course, the earnings reports from big tech companies like Apple, Microsoft, Nvidia, and Amazon are non-negotiable. Their results can lift or sink the entire market. Also, watch for major AI adoption announcements from Fortune 500 companies. And keep an eye on any geopolitical tensions that could disrupt the global economy. So, with all this information, what's a practical strategy? It really depends on your style. If you're a long-term investor, your strategy is simple. Stay invested. Maintain your positions in the AI leaders and big tech. Consider adding some high-quality, industrial, and consumer discretionary stocks to your portfolio to capture the cyclical upswing. And always keep a portion of your portfolio, say 10 to 20%, in a hedge like bonds or cash. This gives you dry powder to buy the dips. If you're a more active trader, the playbook is different. Be ready to buy the dips caused by those temporary shocks from inflation or payroll reports. Play the volatility around earnings announcements and be prepared to rotate into cyclical stocks. As soon as it becomes clear that the Fed is about to cut rates, and for the smart portfolio builders out there, the key is balance. You want to combine growth from tech, the economic upside from cyclicals like industrials and financials, and the safety of defensive hedges. The single biggest mistake you can make is being overconservative. The first half of 2026 is shaping up to be a strong period for the U.S. stock market. The main drivers are expected Fed rate cuts and accelerating corporate profits. Technology, especially AI, will continue to be the powerful engine of growth. But you'll see cyclical sectors start to take the lead as economic confidence returns. There will be bumps in the road, but the overall trend is pointing up, and those moments of volatility will likely be incredible opportunities for those who are prepared. Thank you so much for watching. If you found this analysis helpful, make sure to hit that like button and subscribe for more deep dives into the markets. Let me know your thoughts on 2026 in the comments below. See you in the next video.